This is our quarterly market recap and insights. We do this with Kurt Brown, who's the Chief Investment Officer at Townsquare Capital. Matt Johns in our office joins us. He's just getting out of an appointment, but he'll be joining us shortly. So I'll put him in as a panelist as well. So a couple of housekeeping things to be aware of. Use the chat function as we go, and I'll watch that carefully. If you have questions, if you'd like, you can put them in the Q&A. That's even better for me, because then I can track to make sure it gives me a list that I can go through and say, yep, we got to that question. We got to that question. So if you want to ensure that your question is seen and it doesn't get lost in the chat, then throw it in the actual Q&A and I'll help you with it there. We are probably just going to dive right in. Kurt, I'm going to stop sharing my slides so that you can test out sharing yours.
Great.
And then we'll probably get right into it, just so that everybody knows if this meeting is new to you, either you're a new client of Capita or you just haven't joined us in the past. We try to keep this really conversational, which is excellent because Kurt is so good at this. Basically, this is a deck of slides that is constantly evolving, that Kurt manages and updates based on what he's watching within markets. So it gives us a chance to be able to really talk about what's happening right now. And if we need to bounce around between slides, this is not necessarily a presentation that we have to go through in order. In other words, the more that you all participate and the more that you tell us what is on your mind, the better. We did a presentation, I think last quarter, Kurt, and we couldn't get off one topic the entire time, right? And I almost don't want to bring up the topic because it'll happen again for the entire hour. And not that I was upset about that, but obviously it's what everybody had on their mind. And I'm not opposed to that. So
let's not lead anybody. Let's just go blank canvas, man.
I'm not gonna give them that. Yeah, I'm not gonna lead them into it. But the point is, tell us what's on your mind today. Let's talk about it. I guarantee you there are some slides about it in this deck. What we'll do is we'll get started just as we go, and as if you guys have questions, throw them in. All right. So, Kurt, I'm going to just basically let you drive with this. And I've looked over your slides a bit, and I think this will be really good. Why don't we start with the general overall health and of the U.S. economy? I think that's kind of where your slides begin anyway.
Yeah.
And let's go from there. And then in a minute, I'll probably throw out my top 2 or 3 questions that I'm getting from clients. I'm sorry. One last thing before we begin. A couple of you have clicked the little button to raise your hand. I honestly don't know exactly what to do with that. So just ask a question. If you have a question, put it in the Q&A. But if your hand is up and if you need something, tell me what that is through the chat or the Q&A and I'll watch it. Kurt, why don't we dive right in?
Yeah. Can you see my screen okay?
Absolutely. It looks great. We see you,
awesome.
See the screen. It looks good.
So here's what I'll say, and I know a lot of your clients now. We've talked before. I know this will be a little bit in me saying this a little bit of a repeat, but I really get frustrated with financial journalism because journalism is so much about sensationalism. It tends to be kind of negative. My wife has been a TV reporter for 20 years, and it's a business of trying to get eyeballs on the screen more than it is. So we keep this data because not only do we have you guys, literally hundreds and hundreds of business owners as clients, but then we also talk to a lot of fund managers of every different type of investment style, from bond managers to private equity on a quarterly basis. And so we get really good information like data. So we like to just be able to give you the information and then arm you with it without having it be sort of like with our spin on it. And that's why we really try to do this, because everybody's looking at this kind of in their own way. And I really don't like the way that the media portrays financial journalism. I like to keep the presentation really simple. I mean, there's literally just good things that are happening at any given time, and there's bad things that are happening at any given time. And they just are what they are. They're just numbers, and they're trends. So Zacc, should we go through a few of these?
Let's do it. Let's do the good and the bad for sure.
Okay. All right. Let's go through a couple of these.
I think I guess if you're okay, I'm going to maybe hit that home a little bit harder. Yeah. We have had clients come to us in an absolute fit because they are absolutely convinced that the market is awful, or that the market is going to dive immediately, or a national debt is going to drive it into a panic mode immediately. And we see this often. And it's amazing how though almost, 9 times out of 10, maybe 95% of the time or more even, those are the folks who are definitely dialed in to very slanted media that, one way or another, I'm not leaning to one side or the other of the political scale here. I see it with both political parties.
Yep.
And I see it through any administration. We've seen it for the last 15, for me at least, years, that if you're definitely dialed into that and dialed into it really closely, it will push the emotions one way or another. And I like what we're going to do here. I hope that you can see what we're going to do here, which is we're going to get into the data, like what is actually good, what is actually bad in data in the economy. I think there are going to be a few things that surprise you. I
Yeah.
just wanted to kind of lay that out there. Like, try your best to realize that every news media outlet is trying to paint a certain picture, and it just happens constantly. Guard yourself against that, I guess, is the way of saying that.
Well, and I'll add to that because it's something that I kind of wanted to touch on in our conversation today. But there's always a reason, Zacc, to be nervous and be scared out of good investments. There is always something to be nervous about. In my career, I've kept this chart that you're seeing here for the most of my 30 years in this career, which I started in the business in the early 90s. And there's really always been something really to hand wring about. And it's not that it's not really, truly, genuinely concerning.
These are all
But
big events. These are all big
big,
deal. Yeah.
yeah. And I talked to my dad about hiding under his desk during the Cuban Missile Crisis when he was in school, and these are legitimate things. These are not they're not small things, but also at the same time, the reality is there's always good investments. And so bad things happening in the world does not necessarily equate with selling your investments and going to cash and hiding under a mattress. So if anybody wants this, it's a fun chart. I keep it updated all the time. So let's dive in. Let's talk about some of what we're seeing that's good. And then we'll kind of go into some of the stuff that is a little bit more concerning about what's going on and what, kind of what we're worried about. Can you see that? We get that back there, Zacc?
It's coming now. Yep.
All right. So earnings, number one, because earnings of U.S. corporations are such an incredible barometer. And if I had to pick one thing, arguably are the most important things. Since the bottom of since the financial crisis in 2008, earnings are up 800%. Earnings of the biggest 500 companies in the United States are up 8x since the financial crisis and 44% in just 3 years. So I know the stock market's done very well, but I want to show you why it's doing so well. And this is not something you're getting off the evening news very often. This is just 2 years. So in 2 years, sales, now this is pre-COVID. It's easy to say from the bottom of COVID, everything looks wonderful. But even before COVID, 2 years ago, sales of the biggest companies in the world are up 16%. That's massive. And their earnings, corporate world, the S&P 500, their earnings are up 36% in just 2 years. That is real, genuine economic. Why people like us obsess about earnings of U.S. corporations. You can see that the blue line is what the current estimates are for earnings of 500 companies, right? And the S&P 500 is in green. So the stocks are for earnings. So when you think about the stock market going up a lot, of course, it always makes us nervous. Everyone's nervous when the stock market goes up a lot for obvious reasons, right? But at the same time, it's important why it's going up. And the expectations of corporate earnings continue to be very, very good. Okay, so that's number one.
On that really
Yeah.
quick, because that is probably one of the main questions that we get, which is how can this market do so well? How in the world are stocks still up? And I think this is the bottom line answer, right? I mean, if earnings, if a company is making $10 a share and is later making $100 a share, the company should be worth 10 times its value that it was before. So I think this is something that's really hard for us to understand because we assume stocks are like a gravity and what goes up must come down, when it's actually the inverse in general with the market, that most of the time things are going up. But keep in mind this right here. This is it. If you're trying to figure out why the markets are doing well, the markets are doing well because businesses are making a lot more money than they used to.
That's
and they
right.
should be priced higher because of it. And
And
that
a
is,
lot more.
and like, yeah, and a lot of that is inflation, right? Like people talk about inflation. I don't think people connect the dots here about inflation, that if earnings are going up, some of that has to do with inflation.
Yeah.
I always use credit cards as an example. They're like the easiest one to understand. If all of us are spending more on groceries and more on clothing and more on things, and credit card companies charge a percentage of every transaction, their earnings and their revenue, they're going to go up. Anyway, just keep in mind, inflation can drive earnings in a certain way with some inflation, where stocks have pricing power is what they call it, where they can control the price of their sales. So anyway, the point is a lot of stocks do well during inflation,
Yeah.
and then stock prices go up and they don't have to come down. That's the key thing to walk
Right.
away with here.
That's right. And Zach, I'm glad you brought it up because inflation is always a really hot topic. But what's interesting is if you look in the last 100 years, there have been 6 inflationary windows and periods in the United States. The by far, and we have a really in-depth white paper on this if anybody would like to read it and have access to it. But by far, the 2 best assets that have gone up during periods of inflation have been stocks and land. Stocks and real estate by far. There have been certain windows where gold did really well, or other types of hedging assets, tips and things like that. But and it's because of what Zach just said. Usually there's inflation when the economy's doing well and companies pass that on to consumers. Think about the first smartphone. It cost you $100. You couldn't believe you were paying $100 for a smartphone. Now you're paying $1,300 for a smartphone, and not one person on this call today would do anything to give up their iPhone. No one.
Nobody blinks. They just do
Nope.
it.
Nope.
Hey, we
Nope.
have two, by the way, we have two, I would consider more wage and employment questions that have come
Yeah,
through, one in chat, one in Q&A. Let's wait until you get there, but that's
we're getting
what,
there.
just for those who ask the questions, we're going to hit those in a minute.
And it's a big, big thing. So we're definitely going to talk about that. Something that gets a lot of press is that US corporations are taking out a lot more debt. Okay, in a vacuum, that's true. It's like saying that a TV is a lot more expensive today than it was 50 years ago. Well, of course that it is. But actually, a TV compared to the average income is way cheaper than it was 50 years ago, right? So this is showing debt of US corporations compared to their equity. Okay, it's near an all-time low. So yes, in a vacuum, a lot of debt is being used by the dollar figure, but not as a percentage of what the size of the economy or the company's equity themselves. So you got to be, this is one of those places where journalists love to cherry pick. New all-time high in corporate debt. The truth is we're working on an all-time low in corporate debt. That's actually the reality. And nobody wants to talk about that because it's way too boring. Employment in a picture. These are kind of the numbers. There's 8 million people receiving some type of benefit. There's 10.5 million help wanted ads out there, right? In other words, there's estimated to be about 10 or 11 million jobs that are open right now. And there's 6 to 8 million people. This 8 million, by the way, just came down in the past week. Between 6 and 8 million now, depending on how you calculate it, of the number of people getting some kind of unemployment benefit. Okay. This is the bizarro world. And you can see the net difference is 2.5 million people. Very, very rare in this country to have so many more help wanted signs out than there are even people that are sitting on their couch. So the problem, of course, we all know this now, is twofold. One is you have the government paying people 20 bucks an hour to sit home on their couch. How does the small business owner compete with the young guy making 20 bucks an hour to sit home and play video games? Very hard to compete with that. Now, what that leads to is this light blue line. Okay, this is the wage inflation. And every one of my clients that runs a business is having to pay more to get people to come off the sidelines. Now, so far, that hasn't really hurt earnings a lot because the economy is growing so fast. But when wages go up, they never come down. There are certain kinds of inflation that can be temporary. The Fed likes to call it transitory, Zach, right? It's their fancy word for being temporary. Other types of inflation don't come down. The cost of renting an apartment, dollars per hour at wages and things like that. So this is a big deal. And the federal government's going to have to figure out how to fix this problem because they are in the business right now of competing with small business owners in this country to get people to come out to work.
Which is brutal. So, okay, so this is let's talk about this right now because we have a couple questions on this particular topic. Okay, we talked about earnings going up before. One question that came through is, are profits being shared with workers through pay increases? This gives you an annualized wage growth. So, I mean, yes, but not. My opinion is not really. I mean, the profits are going up at a way faster pace than wage growth is going up,
Yeah, and
right?
honestly, and this is, you always risk getting off into politics with this conversation. The truth of the matter is, the top 1% of the wealthiest people in this country now own 81% of every stock that is in any account. It's a new all-time high, and it's absolutely ridiculous. So the short answer is no, it's not being shared with the low-income people at all. Now, here's the difference, though. Okay, we can sit around and debate this all day. I am certainly, as a free markets guy, I don't care that people are making a lot of money, and I love that there's a lot of profits going on. I'll tell you what's going to happen. Wages are always very, very slow to go up because they never go back down. So people that own businesses, they don't like to just go out and, just be charitable and offer $40 an hour when they can hire for $25 an hour,
Yeah,
right?
especially because when things get really bad, they can't pass on that to their
That's
employees.
right.
Yeah, so
But
that
in the last 90 days, we are really starting to see it. It is becoming very competitive out there for people to hire. So the good thing that will come out of this for the discrepancy between the wealthy and the not wealthy in the United States is you're actually going to see wages continue to go up very quickly here. They've been going up for 3 quarters. That is not going to slow down at all. And this is why you can make the argument you don't need a minimum wage because the market's going to work out the minimum wage. Now, I'm not saying we don't need a minimum wage. I'm saying that's why you can argue that. Because as a business owner, it doesn't matter to me what the minimum wage is. I got to get the best employees I can get in this door, which means I got to pay them more. And
yeah,
But you
especially
are seeing, I'm going to jump in here too. I
welcome,
was going to
Matt.
say,
Good to see you.
I joined finally.
Matt was off working with
Matt.
clients, taking care of them.
How are you?
Thanks, Matt.
I was going to say, you guys, I was in Moab a couple of weeks ago, and McDonald's was hiring for like sub $20 an hour, like $19, $20 an hour so like part of it's like that discrepancy, Kurt, that you're talking about. This wage inflation is helping that lower that minimum wage that you're talking about. The market is realizing, hey, if we want people to get off the couch and get to work, we have to, I didn't think that's quite a good pay for working at McDonald's.
yeah, and I'll tell you what, if you're a politician and you wanted the minimum wages to go up, this was a genius move to pay a massive amount of CARES Act stimulus to people to sit home, because it's very hard to pass minimum wage policies at the state level. But when I've got to go out now and I've got to compete in the open market and pay people to get off their couch and come to work, it's actually working. So the average wage is quickly going up regardless of what the minimum wage laws are.
Okay, real quick. So somebody asked if these slides are available. This recording is available, and Kurt, I believe you're okay if we send the slides out afterwards,
Absolutely.
right? Okay, so we'll make the actual PowerPoint available. Typically on capitafinancialnetwork.com, we have a page for this webinar where you'll be able to click on the link to watch it, or click on a link to download the actual slides. So keep in mind that's available. Okay, so on this same subject of employment, we're talking about this question says, I saw that 4.3 million left the workforce. Is the government unemployment still too generous? We're talking about that right now. I think we've pretty much nailed that yes, employers are competing with a pretty high unemployment payout rate right now.
Oh, and the
it's
government,
tough.
yeah, and the government loves to spin this. They're out with some ridiculous 3.5 million kind of unemployed number a couple of weeks ago because they cheated by saying these people dropped out of the workforce, which is absolutely ridiculous. That's why the real number is like probably between 6 and 7 million.
Yeah. Okay. So then the other one, there was a question about what about March 2020 with corporate bailout by the feds? And I think that was in reference to inflation that we were talking about back then.
Yeah.
And I just want to comment to the person that asked that question and others that we're not saying we won't see inflation. We're just saying that if earnings go up with companies, then their prices can be justified at higher values. So that's the key takeaway there. Inflation is a different topic that I think we will see inflation. Most individuals believe inflation will be a lot faster than what professionals typically think. But I think everybody's on board that we do believe inflation is coming. I mean, we did see a 5.9% increase, right, in Social Security. So most folks are aware and ready for that. But hopefully that answers your question. If not, chat it and see if you're trying to get to at something else there. Kurt, what about impact that we see occurring because of the shipping gridlock? And is that maybe
Oh
something you
man,
want to tackle
This
somewhere
is
else,
big,
or do we
Kurt.
just
This
talk
is
about
big.
it?
This is
this
big
is
supply chain, isn't it? This is big.
yeah,
You
this
normally have slides on this.
yeah, this is a big deal. I'm flipping through my deck here to see. I did update and take some out. Um, yeah, in fact, let's do this.
While you're looking for that, Kurt, I'll maybe jump in a little bit, you guys, and give
Yep.
some context. The ports in California in particular, they have unions that run them a lot, and their hours, they're not working enough hours to where even, I think President Biden even tried to intercede over the past week or so, saying we've got to try to get these ports, these ships that are waiting to drop off these imports, we've got to get them docked. And so it creates more of that supply chain issue that creates more of that
Yeah.
inflation effect that we're talking about.
Yeah, I mean, you know, really from pre-COVID, and you're seeing this on the screen here, to get a container from Shanghai to LA is 6 times more expensive than a year and a half ago. I mean, that's outrageous. We've never seen anything like this, you know, and everybody wants to point the finger at one thing. And like a lot of complex economic issues, it's not just one thing. It's not Biden's fault. It's not, you know, we were running really low on truckers for a decade. We are really struggling to get people to go and become a trucker for a living. This is a decade-long problem, and now it's really, really coming to roost. And so you've got all these supply chain issues. Look at semiconductors. We went from like 5-week ship times to 22-week ship times for semiconductors. Everybody on this call knows you can't even get a Ford F-150. That, you know, there's 1.5 million of them parked out in the middle of fields that are waiting for semiconductor chips. Literally everything else has been done and built. You know, so, you know, look at this, the number of ships waiting, ships, not containers. We're at 70 plus ships sitting off of Long Beach. This is unheard of. There's usually 5. I saw a stat a couple of weeks ago from a research group that we follow. Close to 10% of ships in the world are sitting somewhere waiting to get somewhere. You think about that. I mean, 7, 8, 9% of all cargo in the world, it's a stunning number, right? And it's literally every problem. It started from COVID. Factories were shut down, people laid off. Now you got to get everybody back. You got to retool the factories, you got everything going. So there's the backlog problem from COVID, number 1. Number 2, I don't have the people working. I don't have the people on the ships. I don't have the people driving the trucks. Some of these people, by the way, are the people being paid $24 an hour in California to sit on their couch. Why would they want to go down and work for $28 an hour at the port when they could play video games for $24 an hour? That's what I'm getting if I live in LA County, right? So that continues through every single part of the food chain. Now, the good news is this. When you have these kinds of problems, it opens up opportunity. Think about it like this. A really simple example is when you can't get oil, what happens? Anybody that can pull oil out of the ground goes and pulls it out of the ground and starts selling it, right? So when you have these kinds of problems, it takes time, but you're going to have a lot more people trying to provide semiconductor chips, to try to provide shipping, to try to provide trucking. The problem is in a global economy that's incredibly well oiled, when you get problems like this in the food chain, Matt, it takes months to right it.
Yeah, this is where, and I think the Fed even came out saying that they think they're hoping in a year, a lot of these issues have started to iron themselves out. I had a colleague that was talking to somebody that works at Toyota, and they were saying the executives at Toyota are saying, we think a lot of the supply chain issues that they're being confronted with should be ironed out by next summer. With some of it, to where it is months of, and that's what causes a lot of this inflation popping bigger than normal.
So how do you translate that for us, Kurt, in terms of like to the normal person? Okay, so we've got a bunch of ships out in the water. Like I live inland, so I don't really know what that means. Like I know I'm joking a little bit, right? But tell me, like, how should our clients translate that into their lives and their portfolios?
I hate to say this because I'm not done with my Christmas shopping, but if your Christmas shopping's not done by the end of the month, you're probably going to get screwed. If you look at the screen here, I'm not even kidding you. Look at inventory levels of retailers in the United States. This is the most boring data you've ever seen because it never moves. And since it's been tracked, businesses just keep a certain amount of inventory on hand to sell to customers. There's no inventory. It's real-time turns. All of us have had the experience of going into stores, and they just don't have it. And they just say, when are you going to get it? I don't even know when I'm going to get it. I have friends that have built houses that can't get a stove, can't get a bathtub, can't get they got a brand new house. How ridiculous is you can't buy a stove, right? So
Kurt, I moved in about 4 months ago. I'm waiting on a dishwasher. It's the way it is.
Of course, your kids are learning, good.
My kids are barely learning this. Yeah, keep going. But
yeah.
So then in terms of like translating that in, I think that does affect our daily lives. I do think that impacts some businesses that of course, what'd you say?
And inflation. Inflation is higher. It's up.
Yeah.
There's no way around it. Here's the thing. There are two major problems with inflation. You had a young lady that asked about the Fed printing all this money last year. You know what? There's no way around it. The Fed would love to have you and me believe that there's no inflation. That's ridiculous. There's plenty of inflation, more than they're going to lead on, because it doesn't behoove the Fed to admit how much inflation there is. The second part is the supply chain problem. Matt brought it up. This is what is making everything more expensive. Why does anybody have to compete on price if I can't even get the part? I got things in my life right now I'd pay 30% more for if I could just get my hands on the part, right? So what ends up happening with inflation, though, is that some of this corrects itself. Lumber prices are down 50% from where they peaked. It corrects itself, but some of it doesn't. So some of this inflation is temporary. Most of the supply chain problems are probably temporary. You know why? Because we're all greedy, and people will figure out a way to make money and profit from the fact that Zacc can't get a dishwasher. Mm-hmm. Somebody's going to get Zacc a dishwasher, right? So those types of problems get mitigated. What doesn't get mitigated is the other types of more permanent inflation. But pretty soon you're going to buy a used F-150 again for less than a new F-150. That will happen again in not too long.
Well, in Kurt, we had a question come in. What aspects of inflation are impacting us? It's just that, like, used cars is a big component of it. Used cars,
look at this.
Travel, insurance, energy, a lot of these things that you're talking about, those are the areas that are being impacted by inflation and are having an impact on us.
Yeah, you used to have, look, in the 90s, you had 1.6 million brand new vehicles just sitting around waiting to be sold, right? You got 100,000 of them out there. Right? There's no inventory. There's nothing. You know why? Remember this. Think about all our business school classes that we took 20 years ago, 30 years ago. We talked about real-time inventory. Computers made it so that you could order now, build the part, and ship it next week. You didn't have to keep a bunch of inventory around. If you have a global supply shock, what does real-time inventory do for you? You're murdered. So this is the weakness of real-time anything, right? Is if you can't get it in real time, suddenly you're out of business. Now the old school auto parts store down the street is my favorite guy because he was just holding on to a bunch of inventory for me, right? And that's where you get these phenomena, where a 1-year-old vehicle is now the exact same price as a brand new vehicle. That's ridiculous, right? This is now going to be righted. It's just going to take a little while.
Kurt, a question. Let's go. I want to get into the actual pricing of stocks because there was a question in here that I'm going to explain it a little bit for the audience because this person who asked the question understands financial ratios probably better than most people do. But basically, Shiller PE ratio. Okay, without going into a ton of detail, folks, basically what they're saying is you take the price of a stock and divide it by its earnings. It gives it a ratio. You should be able to tell how expensive or cheap that stock is based on its price divided by its earnings. So if it's earning $5 a share and 20 times it has a 20 PE ratio, that stock's at $100 a share. So that's the simple version of understanding a PE ratio. The problem is that some businesses go through cycles. So PE ratios can fluctuate a lot. So there is a way of saying, well, we'll take the current one and look at it in relation to the last 10 years of PE ratios on that stock. And then we can even out the cycles. Okay, so that's the intro to the question here. And the question is saying, hey, we've seen charts with that Shiller PE ratio, the one that shows over time that if you look at the last 10 years, we're about as expensive as you could ever get. But according to the first couple slides, we talked about earnings going up, so prices could be justified that high. So here's the bottom line question. First of all, however, if we think that Shiller PE ratio is a valid measure of prices, like, is there a reason for concern?
The short answer is yes. And this slide is in my section of things we're worried about, we're concerned about. assets are not cheap. And if anybody's telling you that anything is cheap, they're nuts. There are things that may be cheap on a relative basis to something else. We are not in a world of cheap right now. There is liquidity and cash everywhere. Supplies of everything are down, and which means you have a wall of capital investment chasing too few assets. There are too few things to buy out there, and this includes investments. And so when you look at this is 6 different ways to measure what Zacc was talking about. This is 6 ways of measuring how expensive stocks are. Schiller is one of them. 5 of the 6 have the market being too expensive, right? If you compare the market to interest rates, it's actually too cheap because interest rates are basically nothing. This is what's driving the market.
I think that's a huge point, Kurt, that we don't talk about. And if you think about it, I've used the home analogy of this. And Zacc, I think I even talked with you about it, where if you bought a $700,000 home in 2008, your payment was about $4,500. That same home purchased today with a 3% interest rate is worth about 1 million, 1.1 million. Same monthly payment. And stocks have seen a similar effect, in what's driven the home price appreciation has been these interest rates going down. And stocks, Kurt, to your point, have kind of seen a similar trend take place where people are willing to pay it because there's no alternatives to put your money to work.
Yep. In our business, they call this the Tina trade. Everybody in my business is talking about Tina. And Matt just said it. It stands for there is no alternative. Okay, so most of us on this call will remember a time that you could buy bonds and make 5% return very, very safely. Okay, that is a thing of the old days. So now many of us are being forced to say, I'm either going to be ultra safe and make no money, or I'll pay a little bit more for good investments that are growing. And Matt's point is in this picture right here. This picture, this goes back, into 1970. Okay. This is stunning. This is, everybody says, oh, housing has gone up so much.
Or in this range. But that would be predicated on, there's different ways we can do it. The economy can grow. Companies can earn more revenue, right? And these can drive this PE down, but you're spot on.
Yeah. You know what? Another thing, Zacc, on this stocks in general is that, 5 of the 6 largest companies in the world now are technology companies, right? Google, Facebook, Microsoft. And there's a lot of talk about 2000, the dot-com bubble, how expensive tech stocks were. Tech is very different than it used to be. Tech used to be a very speculative type of investment. But now the biggest, most stable companies in the world are technology companies now. In fact, if you look at what happened during COVID, technology companies were actually safe, and old line companies that had tangible brick and mortar assets were dangerous. It's a new world. Google and Microsoft and Facebook are sort of the safe bellwether companies now. So this is looking at the price to earnings ratio of just the technology companies in the United States. And it's nowhere near what it looked like in 2000 during that dot-com bubble. And I'm not saying it's cheap, and nor am I saying the stock market can't drop 20% at any time. I'm just saying that when I speak with people that have money, they feel like they are being forced to just pay a little more for things like high quality companies, high quality real estate, and things like that. Because what else am I going to do with all this cash? If I sit in cash, inflation's going to kill me. And if I buy bonds, I'm only going to make 3% return.
And the reality is it's probably changed the landscape moving forward. Would you rather own a US Treasury bond that pays you 1.5%, or would you rather own Apple stock and get a 1% dividend and also participate in the potential upside of, what they've done historically has been remarkable. But that's kind of the parallel that the markets are in, as they're saying normally we'd be fine to de-risk and go with 2%, but we'll take a 20% return plus the 1% dividend, and we're coming out way ahead.
Hey, Zacc,
go ahead.
There's something, if we're done with that subject, I do really want to touch on 1 or 2
Why don't you do that? Because we keep getting questions through, but I do think it would be good for you to tell us what's on your mind, because I know we know, obviously we want to make sure we answer all the questions from clients, but this is your world. What are you paying attention to? What do you think is most important?
Let me shotgun a couple of these to you, and then let's open it back up. And
that sounds great. Let's do it.
I think there's some important data because it's a place where the media really likes to spin a yarn. Okay, so let me give you just a couple things. Number one, there's a massive, massive amount of cash out there. High net worth families in this country, families worth more than $1 million of net worth, have never held so much cash ever since the data's been recorded as a percentage of their portfolio, not just the amount of cash. There is cash everywhere. We manage money for 1,500 high net worth families in this country. They don't know what to do with it. It's a problem. For them, this is a high class problem to have, but this is a problem. They don't know where to put their money. There's S&P 500 companies, same thing. There was a real stable amount of cash that they held for decades, no longer. Even US corporations don't exactly know what to do with their cash. Okay, this is important. Going into the financial crisis and into the dot-com blow-up, the two of the three worst market events in the last 25 years, okay? Households were in a very, very bad position. The average American was not ready for a financial crisis. Okay, so I want to show a few of these. Since the financial crisis, right before we went into the financial crisis, fall of 07, this is how much debt U.S. households had. This is how much their assets were worth right here. Look at this. Look at this. We've almost doubled what the average house's assets are, and we are at the same exact level of their debt. It's a little bit higher. 3 to 5% higher in debt. So almost 100% more assets, but almost no more debt. Americans are not getting out over their ski tips. They are not borrowing and speculating on other investments. This right here, that's how much of your available credit you are using. Since the data's been recorded, you've never used so little a percentage of your credit that's available to you to use. Again, the average American doesn't want to borrow a bunch of money. This right here, this is maybe one of the most stunning charts I've seen in 30 years of doing this, okay? We are Americans and we love to spend money. And this chart says the more you make, the more you spend, okay? Right? This is the United States of America. If you make more money, you're going to spend more money. By the way, Japan is not like this, but America is like this. But no, not since COVID. Since the first quarter of last year, okay, we are making more and spending less. It is absolutely ridiculous. And the reason I go out of my way to point this out is that this is not the kind of speculative behavior that you see in euphoric markets where people are being reckless. And everybody wants to fearmonger and talk about how reckless our markets are. They are not. And the average American right now is not acting that way. The average American is still acting very, very conservative. Again, stock market could go down 30% at any time. None of us know that. But we are not building this on the back of something fundamentally unsound, right? Look at this. Since the 70s, if a bank takes in money, okay, commercial banks, loans versus deposits, if they take in money, they lend it out. That's how banks make money. Do you know what the problem is? You don't want to borrow it. The banks have an insane amount of cash and they don't have enough demand to loan it out. So this will really show you what the actual posture of the average American is right now. And this is really stunning. For those of you that are worried about a housing bubble, okay? Now, we might actually be in the opposite. We might be at the beginning of a housing expansion. I know that sounds completely nuts, okay? But a lot of smart people think that our economy underbuilt between 3 and 4 million homes in this country that we still need to build to satisfy demand, because we went through a decade after the financial crisis of not building hardly any new homes. And so when you look at what's going on, this is mortgage origination. This is the financial crisis beginning. And you can see down here a lot of subprime lending. The light blue is the people like all of you probably with really good FICO scores, right? And it wasn't a very big part of the mortgage market. Well, look at today. almost the entire mortgage market is being made up of the highest credit scores. There is very few mortgages being initiated to subprime people. The banks got burned so bad in the financial crisis, they are just not wading back into those waters yet. Little tiny bit now, but a blip. And so when we talk about the financial health, Zacc, that's sort of under the hood, things are a little expensive, but the fundamentals are actually incredibly sound. We are not using too much debt compared to what we've done in the past. And we are a real cash-fueled economy right now. So I want to be sure I got those things out there.
I like it. Anything else before I dive into some questions that you feel like we
No.
should show? Okay. So
I'm going to pause though, real quick. I said that. I had to jump in.
go
Zacc's
for it, Matt.
Don't go for it. No, I was going to make the point because Kurt brings up the cash. And I think this is so interesting because I don't think you would hear this on the news. I ran the numbers on some of those cash charts that you had there, Kurt. 2002, where we hit a high, and then 2009, where we hit another high. And now we're at levels that exceed where we were at in 2009, which was the post of the recession. And when I got those numbers put together, the average return or run up that we experienced in the market, once that cash was starting to be deployed into the markets, translated in 2002 to about 3 years, average annual return of about 18%. In 2009, it was about 6-7 years, average annual return 26%.
Yep.
That means we could have 5 years of a run averaging roughly 22% rate of return. And last year we got 18.5% in the S&P 500, right in line with these averages. And this year, lo and behold, we're right in that range again, meaning we could, if we hit the average of what the last two have done with the amount of cash there is, we could have another 3 years, which I think that sounds crazy, but it's an interesting point.
And it's really, it's a virtuous cycle. Like right now, so many of our high net worth families that they've sold businesses in the past year or the past 6 months, they're flush with cash and truly don't know what to do with it, Matt. I mean, your point, the reason cash levels being high is so bullish for the economy is people don't sit on cash forever. They might temporarily sit on it and wait, but people want some return on their money. And if the checking account and treasuries make you zero, what are you going to do? And so every time the market has even a little pullback, my phone starts ringing with people saying, hey, should we put some to work? I got all this cash I don't know what to do with, And so it puts a real tailwind behind the economy and behind the market.
Yeah.
All right. So a couple questions. So we had somebody ask earlier about the bond bailout 2020, spending money and bailing out corporate bonds in particular.
Yeah.
And I went back and forth on the chat a little bit to clarify the question. And the question was more around like, it sounds like the person doesn't really love that. It doesn't feel like a free market activity to have done that, which is completely understandable. But the follow-up questions from her were more along the lines of, well, what would have happened had they not? And was it worth it? And maybe some insight into that would be helpful.
I see Annette's questions in here. And by the way, they're brilliant questions.
Yeah.
I mean,
it's just tough to answer.
Yeah. Honestly, like I was an economics student.
She's grilling us.
I know. I love it. He needs to come into the room and sit in the investment committee.
Right. We've got space for another camera here, Annette.
Absolutely. Honestly, Annette, I kind of agree with you. And in fact, the Fed right now is still buying mortgage bonds like there's no tomorrow, $40 billion of them at a clip, and it's asinine. Why is the Fed in there buying mortgage bonds in a mortgage market that looks like it does right now? This is absolutely ridiculous. Is there a moral hazard? Of course there is. Zacc, can I go to the charts again?
You do whatever you need. Yeah.
Am I allowed to show this?
You should be able to.
Okay. To answer the first part of your question, the Fed had to do something last March because they were making it illegal to go to work. Okay. That's different than an organic recession. Okay. Where companies should be ready for that kind of thing. Right. So we were in a little bit of a peculiar situation and that we sort of had to fix that. And it looks like maybe I don't have that chart anymore. So I'm going to pull that back down. Sorry. But I really thought I had that in here. I wanted to kind of talk about some of these zombie. Oh, you know what? I'll show this one. So here's what happens. Okay. And this is one of my biggest concerns that I don't think actually gets enough attention. Okay. Because interest rates are so low and because cash is everywhere. there are companies that are able to borrow that in prior decades never would have been able to borrow money. They would have been bankrupt already. Okay. So this is actually interest coverage ratios. In other words, if you take a business in this country and you just take what the interest payments are on their debt and you compare that to how much profit they have, okay, we have a lot of companies that are what we call zombie companies. They're the walking dead. And this is a really interesting chart that takes the weakest 20% of our companies that trade on the US stock market. Okay, the weakest 20%. Okay?
Can I just clarify here? So
Yeah.
as we're looking back at like 1990, for example, and we see that line starts out in the 89, 90, and it's at about a 1. So what you're, and if maybe I can interpret here and see if I understand it entirely, but a 1 means that their profits are pretty much all going to interest. A 1 is for every dollar of profits, there's a dollar of interest in that ratio. Is that right?
It's actually what they've done is they've adjusted this chart. See the gray line there?
Yeah.
If you're above the gray line, then what it's basically saying is even the weakest 20% of companies that are out there, they make more money than they owe.
So it's not like a current ratio. This is like it's positive or it's negative. And if it's positive, they've got a little extra money. And if it's negative below 0, they don't have money.
That's right.
Okay.
So what happened was this was a very specific reason. We had a rash of companies coming public that were literally just business plans. They weren't even making sales yet. So the weakest 20% of our companies that traded on the US stock market were awful from a profit standpoint. Remember all the .com companies that were coming public, like, pets.com or whatever? But you don't normally see that. And you usually only see it in periods of stress. So if you take this back even to the Great Depression, you rarely get under the gray line. The only reason this was because it was the great financial crisis, right? But look at what started happening here. The weakest 20% of companies, again, really start being underwater around 2015. And this is when interest rates got really, really low, and it became really easy for companies to borrow. Well, look at this. The stock market itself and the economy itself is going in this direction right now, right? Ever since COVID. Why are the weakest 20% of companies going this direction? And this makes me nervous. And it's why we are always beating the drum that even in your bond portfolios, you want to be absolutely certain about what you own, the types of companies that you are lending money to. Like when you buy bonds, you're lending somebody money, right? Because the next time we have a nasty recession, okay, a real one, not this COVID thing, but a real natural recession, there are going to be a lot of bankruptcies. And so in the world that we live in today, it's not enough just to own everything. You need to start being a little bit picky about the nature of the assets that you own. And this is precisely why there is a lot of walking dead out there. So Annette's question is spot on. There is a moral hazard here. And what happens with government programs is once they're instituted, they're very hard to get them killed off. So I actually think a lot of things we did last March were smart and they should have been short-term, but our government hates taking the punch bowl away. Politicians don't like saying no. So now we're having a hard time removing some of those incentives, even like buying corporate bonds and things like that. It's a great question and it needs to change. We need to normalize.
It needs to slow down. One thing I was going to say, I find that if the Federal Reserve didn't step in to start buying some of those bonds, the bond market tends to be a lead to the stock market, meaning that people say, what's the bond market saying? That's what the smart money's doing. And if the smart money's panicking and doing really bad, it sends negative ripples to the stock market. So not only did they need to step in because of you've got companies that you've told them they can't go to work, everybody needs to go home. You also had it from a standpoint of they were damage control. They were
and think about this. If you're the government and the airlines all go out of business. I mean, let's name names. We bailed out airlines. We didn't really need to bail out cruise lines. I'm not sure that's when we needed to bail out. But with airlines last year, can you imagine the chaos in our economy? If you just let all the airlines fold last year, I mean, it would have been just the cost to our economy would be so much greater than the bailout money that went to help these airlines. And by the way, just like with the great financial crisis, and a lot of people don't talk about this, we bailed out General Motors, but the government made 4 times their money on the loan that they gave to General Motors. So the government's not totally stupid. They come with their teeth in you too. And the airlines are going to have
partially.
To
I mean, I have to point that out. Not totally stupid, but just partially is implied there.
I'm not a big government guy. So.
I can tell. That's so then, hey, real quick, a couple of things here. So we do need to answer a couple questions before we get out of time. We did have somebody ask about maybe what do you do? And really they're asking, what does Capita do to help stay away from some of these targeted areas? And Daniel, there's a question in there. I want to make sure we get to that as well. But okay, so a couple of things you can do in your portfolio and that Capita does in the portfolio. We don't put a lot of money in high yield bonds, which is high yield bonds is a fancy way of saying junk bonds. Those are the same category of asset classes, whether or not you want to say the nice way or the mean way of it. The junk bonds are ones that have really low credit scores. They pay high interest. So a nice way is high yield. But we tend to not really do much at all in high yield or junk bonds. We work closely with Townsquare on our portfolio design. And we like at times to use individual stock ownership so that you can sort through and buy high quality businesses. Part of this theory of either own individual stocks and concentrate down into highest quality, or we buy index funds, but we avoid asset classes, or at least minimal exposure to asset classes like high yield bonds and too much emerging markets. We tend to buy more of your core larger companies, things like that with index funds. But the idea is you can improve the portfolio through some concentration, through owning fewer positions, and that can help you avoid some of the zombie asset classes. So in other words, if you're trying to figure out how do I make my portfolio more conservative, this may sound counterintuitive, but one of the best ways of doing that is actually owning fewer investments, because you can siphon out some of the bad. So that's something, but that's a very individualized conversation with each person on this call to talk with your financial advisor about.
I'll give you one other tip. Matt and I have talked about this before too, is be really careful. Like if you're just out doing your own research on Morningstar or whatever, and you're like, hey, I need to buy a good bond fund or whatever, just be really careful, because a lot of the best performing bond funds are actually full of junk, because during good times, junk bonds have been going up faster than conservative bonds. So you'll run your own screen and say, oh my gosh, the best performing bond fund was this bond fund that did this and this. But if you get down into what they own, you find they own a lot of garbage down there. So when I say know what you own, I'm saying really actually understand what's down inside the funds. And we're ultra careful about the nature of the bonds that are down inside of these different investment products.
I had a review today where, Matt mentioned markets have done incredibly well, and this client was double digits and then some, doing really great on their stocks. And I looked at the review of their bond portion of their portfolio was up 1.5%. And this is, so it's not exciting, folks. You're not going to make much out of it. This is what Kurt is talking about. But the impetus there, or the feeling is, well, I should get out of those and I should buy the stocks that went up 20%, but that's not the right answer either. But you do pay for quality. You're going to pay in lost upside with high quality, and that's okay. That's part of the portfolio design.
And I'll tell you guys a story. And I don't want to create a Capita commercial here, but this is a true story. Last year during COVID, and we manage money for a lot of people around the country, Zacc called, during the middle of late March.
From my unfinished basement at my house.
I remember this like it was yesterday. I mean, it was to the day, the low in the market, March 23rd. And Zacc called and said, listen, all those parts of our client portfolios that are really boring, the stuff that's making no money, it might be 10 or 20 or 30 or 40% of somebody's portfolio. It's time. Let's sell some of those really, really boring, stodgy bonds and buy some of this stuff that's been absolutely obliterated, And that's why even in great times, you want to own some part of your portfolio that's very boring and very stable. So you're ready, because no one knows when the next market accident's coming.
No, and we figured and thank you for saying that. Just clients on this call, per $500,000 of investment, we did the math and figured that created, and just that rebalance by itself created about a $3,000 to $6,000 excess return just because of that. So it's something you got to be active on it and think about it. All right. So back to portfolio design. This is the question from Daniel. So if stocks do look somewhat expensive, and we get this question, Daniel, from professionals to novices alike. What do you do exactly? And so you basically, for everybody else, stocks are expensive. The biggest companies are taking over the large indexes. What do you do? Do you move more to value stocks, international, emerging markets? And this is the Tina trade that Kurt's talking about. Like, you feel like what are the alternatives? And Kurt, I'd love to know your opinion about how much you shift away from these high growing, maybe tech stocks and high large cap growth stocks into other classes.
Matt, I know, has thoughts on this too, because we've talked about this at length before. I have the most boring answer ever. You shouldn't say that about your own answer, but number one, nobody is smart enough to move around and figure out what the next thing that's going to hit is. You're just not. When you build an investment portfolio, you're building it thinking over 10 years, I suspect the economy will grow. I want to be exposed to these asset classes. And somewhere in there, we're going to have one or two nasty drops like that. You just build a portfolio that's sort of geared for that. So Zacc, I'm never out of ever the great dominant big tech companies. Never. I'm never out of them. But what I do is if they go up and they become too big a percentage of my portfolio, I rebalance them and I sell some of them down. And this term rebalancing, I'm going to buy some of the stuff that's hated. Okay, give an example. There was a point where energy companies in this country were 10% of the S&P 500. Last year, at one point, it was only 1.3% of the entire S&P 500 was energy companies. So a couple times last year, I sold down some of my big tech winners, reduced them a little bit, and bought some of the hated stuff. People hated financials and banks, hate energy companies. You know what? In some ways, I was wrong, right? Because the tech companies still went up more in the past year than energy. But energy's done very well now in the past year. So have the banks. And I'm not smart enough to know. So my short answer, Zacc, is I try to own a little bit of all of it. Small and mid-cap companies, a little bit of, big international, a little bit of emerging markets. I own some boring bonds. I don't get too heavy or try to put too much of my wealth into one or two spots in the economy, because there's been times in the past that was devastating. And at the time, it looked brilliant. In 1999, you could have easily dumped everything into the internet. Yeah, you had a few Googles, but you also had a lot of them go bankrupt and just vaporize and go away,
Right.
So
and
you really need an allocation that you rebalance in time,
And to get to that allocation, so that's a combination of two things. One, what the individual client needs, and two, a belief set from a portfolio manager. So we're putting those two things together. Too much for today's call, but in general, Capita and Townsquare, we do have some belief sets. We tend to bias towards a couple asset classes, but that doesn't mean we avoid the others entirely. It's funny. I listened to a portfolio manager years ago talk about how awful the market looked in a couple asset classes. And he spent an hour on it. And at the very end of the call, one of these calls just like this, someone asked, well, what are you doing with your portfolio? And this was a portfolio manager that had the freedom to do anything and go anywhere. Their mandate was a 60% stock portfolio, 40% bonds, and they were at about 52% stocks after he just reamed the market conditions. And so I was like, oh, okay, so you reduced it by 8%. Okay, great. Like, a lot of people don't realize that we get really passionate, but Kurt and Capita, we tend to be really disciplined and make minor adjustments in and out. If you want to learn more about like the biases and tilts that we go towards, let us know. But like, for example, a younger person, we're going to put them more in smaller companies. And that's an individual tilt for them. And then there's biases and beliefs. And as those two come together, we live there, and then we adjust a few percentage points beyond that based on market conditions. Hopefully that gives you kind of a theory around portfolio management. All right. So it was inflation was the topic that we couldn't get off of last time. So our last question as we wrap up today, of course, has to come back to inflation. And I know the individual that asked, I really do appreciate it. But the question, Kurt, it's two-part. What do you think inflation will do over the next few years? And will that increase interest rates?
It's not 2.5% inflation like the Fed wants you to think it is. That's a laughing statement. It's not 6.5% like 2 quarters ago GDP print. That's temporary. There's too much weird stuff. 42% of that print of inflation was just in used cars. 42% of the entire number was because of used cars. Okay, where is it really? It's probably 3.5, maybe 4 is probably the real inflation rate right now. Secondly, there is no worry about hyperinflation in the United States. There is no country in the world that has experienced hyperinflation that wasn't having their currency crater in global markets and their economy was a joke to the rest of the world. The United States is the safe haven. Give me another currency that's going to become the reserve currency of the world. The Chinese, are you kidding me? Are you kidding? The Japanese? London? No. So when people get nervous, they race to the United States. So we are not going to have a hyperinflation event. We're not going to be carrying around dollars in wheelbarrows. This is not going to be a thing here. But the Fed is really working hard to pull one over our eyes. We're not running at 2.5%, right? We're running like 3.5, 4, 4.25, something like that. Here's the problem. That inflation rate with really low interest rates means you're going to have to be willing to either just not make much return because you want to hide in bonds and cash. That's fine. Should be part of your portfolio anyways. Or you're going to have to own some assets that are a little bit more expensive than they normally are because you just don't have a lot of good options and alternatives right now. That's my 2 cents.
And most people aren't worried about 3 or 4% interest. They're worried about 10% interest. And I think what I'm hearing from you is that we don't need to worry about 10% interest right now. We need to worry about 3 or 4, which by the way, is still a risk. 3 and 4% interest, like you said, forces you to take a little bit of risk in the portfolio to keep up with that.
Well, that's like if you buy bonds that make 3%, you sleep well at night and you literally are losing money.
Yeah.
Because inflation's a 4, right? I mean,
yep. Go, Matt.
And I was just going to say the interest rates in the 70s and 80s or 60s to 70s, right? When they were plus 10, that's when the Fed raised interest rates substantially because of inflation. The interest rate where I anticipate they'll probably look to raise it is because of what the Fed has said is when employment numbers start to look better. So when are they going to do that? I bet it's when those jobs that are empty that Kurt talked about, when they are filled, then you're going to start to see that climb. And it's going to go just a little bit though, because the government has been spending a lot of money and they can't afford to service their debt if they raise it to 6%. Anyways.
And the Fed, and look, the Fed used to be more cryptic. They're not even trying to hide it right now.
Yeah.
No, it's telegraph.
They want to run things hot. So don't kid yourselves. The Fed wants to run things hot. And so I know people are nervous, but the risk actually is being out of investments, probably not being in investments, right? The Fed is really making their hand clear right now. So Matt, I agree with you 100%.
Wonderful. Thank you, everybody. We appreciate you joining today. We're going to wrap it up. Of course, if you have questions, talk to your financial advisor at Capita. There are 12 of us now doing this financial advisor job and about, I think, 14 more supporting. We have a great team and growing, but give us a call. We'd be happy to help. Thanks for joining us today.
Awesome.
The opinions expressed in this program are for general informational purposes only and should.
And y'all know I have to play this, but you don't necessarily have to stick around, right?
It's your daughter.
Expressed by
right?
What did you say, Kurt?
Isn't this your daughter?
That's right. That's right.
Capita Financial Network. Past performance discussed is no guarantee of future results. Capita Financial Network does not provide tax or legal advice. If you have further questions, please contact your financial advisor.